Okay, hi everyone. Hey, welcome to the session. If you get to watch this later, what we're gonna do today is run through 8 different solo talks. So it's really meant to be a showcase of just, I think some of the cooler innovations of DeFi and applications built on Ethereum over the last year. I have personally used all of them, so maybe I'm biased and I think they're all really cool. But yeah, I think within like 10 or 15 minutes, you should have a really good sense of 8 different applications that you can potentially use. I think they come in all different varieties here in terms of utility. So we're going to have a talk on outlet finance, which is more related to interest. We'll do ArTrees, which is no loss, like charity mechanism for helping to get trees planted. We've got Mintbase, which is where I mint my NFTs and I check out art that's minted. We've got Loopring, which feels like Coinbase Pro, but it is in fact a DEX, which is insane. And then we've got Nodar. It's Zapper now, right? Am I saying that correctly?
Yep.
Yeah.
Yep.
So everyone knows Nodar. He started DeFiZap, and Zaps are like the easiest way to get people onboarded to using really powerful DeFi transformations. You've got Unlock, which is like the next generation of gating content. And who else am I missing here? Arjun is not on yet, but Arjun will join us from Connext. I think he's probably just running late. So why don't we start then? We'll just go in the order, guys, that I had in the calendar invite. So Nodar, do you mind going first?
Yeah, sure. I guess I'll go ahead and share my screen.
Excellent. Yeah, thanks so much.
Let me know if you guys are able to see it. Should be
Yeah,
good.
it looks great. All good.
So as Travis introduced, we are now Zapper, and I'm Nodar, one of the founding team members behind Zapper. So we recently established as a result of a merger between DeFiZap and DeFiSnap. And we decided to come together for a common goal of abstracting away the complexities of accessing new opportunities in open finance. Today, I'll actually talk about our approach to composing new use cases in DeFi. As I'm sure all you guys are noticing, every day almost, DeFi is getting more and more difficult to use, right? There's new platforms being launched, new opportunities, and each one is trying to solve a unique problem in their own unique twist. So the end users, they're forced to adapt to multiple different interfaces, which of course kind of stalls composability, right? Each one of the protocols themselves, they're essentially competing for liquidity, if you think about it at the end of the day. So they're not going to build out experiences to help you easily switch between themselves, right? So how do you look for these new use cases? Like, how do you actually spot them in the market, and which ones are actually novel use cases and which ones are just simple kind of augmented services from traditional finance? I think first and foremost, you have to look at who it is that you're composing for at the end of the day. At the end of the day, what matters is the end user. And you have to constantly observe what users are trying to accomplish and understand why they're choosing that strategy. After, you can utilize viable platforms to help those users optimize their assets for maximum potential in DeFi. So the first thing I do is I follow the chain. That's my best user survey. Over here, I just kind of took a random, pretty, I guess, power user of DeFiZap, specifically one of our Seth Unipool zaps. So this user has zapped in 6 times into the Seth Unipool. And what I typically do is I tend to kind of look around into what kind of transactions users are making in DeFi, seeing repetitive transactions, and obviously seeing how we can optimize this for end user, and then perhaps add on a unique twist, a unique addition to what they're currently doing, perhaps maybe something they weren't aware of before. To me, transactions speak louder than words. There's a lot of people obviously talking on Twitter and stuff, but what matters at the end of the day is what kind of transactions they're making on chain. So the first observation, which is the reason why we created our Unipool Zaps in the first place, is we noticed a lot of people who are starting with just one asset, they're forced to find an appropriate proportions of another asset in order to come into a pool with. So I'm sure maybe a lot of you have heard of the first kind of series of Zaps that became really popular. But then our second observation after some iterations became that literally every person who would pool into the set Unipool, they would then go on and stake those pool tokens in Synthetic's new Unipool incentivized contract. So what happens there, you basically stake your pool tokens and you're accruing SNX incentives on top. So our solution for this was making a simple UI, kind of helping users stake their newly zapped in pool tokens in the Synthetics contract. But then there was a third observation, which you'll see on top over here in this slide. Essentially, every time this person received and claimed rewards of SNX, they would rebalance them into ETH. So they would just, what this person cared about at the end of the day is having more ETH, right? The Seth Unipool token that he was having was both balanced in ETH and Seth. And now every time SNX is claimed, it's rebalanced into more ETH. So clearly, this person, his goal at the end of the day, or her goal, is getting more ETH. So our solution for this was something called ZUni. So what ZUni does is it's basically sci-fying your experience for staking your Unipool tokens. So essentially, you're able to constantly redeem the SNX claims, and they're automatically rebalanced into yet more Seth tokens, which are then restaked. So in addition to simply rebalancing SNX into more ETH, we took it a step further and kind of then took that rebalance and restaked it into the Seth Unipool. So now for this user, the rate of incentive reward, basically the way it's getting accrued, the rate of accrual is getting increased every time the rebalance happens, because now this person has more tokens that are staked. So what this really leads to is what we call an agile component is sort of set in stone, and you should be constantly iterating and kind of like watching what your users are doing in order to come up with not just the best solution for that time, but be flexible and kind of iterate and grow with your users. Today, we're actually announcing a new building block that you can plug and play with. It's ability to add liquidity to curve pools in one transaction. You can get started on Zapper.fi. And yeah, hopefully we'll continue furthering user adoption in DeFi. Definitely something we're very proud of here at Zapper.
Awesome. Thanks, Nodar. That was great. You know, I guess we can just continue on then with Julien from Unlock. Julien, you want to share your screen?
All right. Can you see my screen? No, looks like it's okay. Share.
There we go.
Cool. All right.
All right. Thanks, Julien.
All right, let's do this. Let me share. No, that's not what I'm trying to find. Present. Cool. Thanks everyone for coming here. I'm going to tell you about something that I think is not perfectly DeFi related, but it's the idea that the web itself needs to change its business model. And yes, DeFi can help in that way, but I think more importantly, the tools that DeFi is built on can actually be reused for other different things. So I'm sure you guys know about the web, and it's mostly monetized through what I call attention, which is mostly advertisement. The idea that we're going to put eyeballs in front of banners, in front of content that somebody else is paying for. And I think this is kind of showing its limits. And so one of the ways this is showing its limits, it's pretty obviously around the fact that we cannot trust the information that we're seeing online. One of the examples that I share a lot these days is about the virus, obviously, because this is what everybody's talking about at any point. A couple of weeks ago, the New York Post, which is a publication here in New York, posted a story. It's like, hey, don't buy the China story. The coronavirus may have leaked from a lab. And obviously, when you read the story, it's, yeah, it may have leaked from a lab. I don't know. This story actually doesn't provide any valuable insights. The only thing that it does is create clickbait. It basically attracts the eye, because this is exactly what the New York Post is paid for, is paid to steal your attention, make sure that you're kind of attracted to something. And so we're in a world where the incentives of content creators, in that case publishers like the New York Post, are not aligned with the incentives of content consumers, which is basically citizens who want to make informed decision when it comes to deciding what they know or what they believe and that kind of thing. That obviously creates a ton of challenges. Among the challenges, obviously everything that's kind of information overload related. So we've been talking about this for 20 years at this point on the web. It's like, oh, there's way too much content. How can I digest it all? Clickbait, which is exactly what I've shown with the New York Post example here. Fake news, which is often, unfortunately, too often we start to see stories that are completely false on every aspect, but the only reason why they exist is because the people that are actually writing them are paid to do so. They're paid to write these fake stories because they end up attracting the eye more. Awful UX, like another example, like I'm sure you've all through that, but if you go to publish a website or even like a website, not necessarily a big publisher, but you end up having all of these banners, all of these messages, all of these notifications that ask you to do a million things, which are in the end kind of not great experience when you want to consume content or application, as a matter of fact. Distrust, it's another example. Like unfortunately, a lot of the ads in the crypto space are around ICOs or very unsavory project, like some of the famous exchanges which are banners, and in the end, when you look at the content of these banners, you kind of erode the trust in the exchange itself, because you're not sure that the platform that you're on is actually something that's have your best interest in mind. One of the consequences of this is, like, obviously more and more people are using ad blockers, and I think this is actually I do use ad blockers, so I think it's actually a good thing because it makes our browsing experience much better, much easier. The challenge, though, is that this is kind of a blanket solution. There's a ton of legit content and legit creators that are not being paid, because when we use these ad blockers, we're also basically not allowing them to be paid. That also means that few players, Google, Apple, Facebook, Amazon, are pretty much everywhere on the web at this point, because these are the platforms that are large enough to kind of monetize on their own term and kind of impose their terms to everybody else. And that's definitely one of the big challenges. There's a lot more privacy laws, which is kind of, I think that's pretty obvious in Europe, coming to the US as well, is the idea that since all of these advertisements are actually stealing a lot of our private data, governments have been starting to regulate this. It's happening with GDPR in Europe, which you probably know of, but it's also happening here in the US, in New York, specifically in California as well. Some of the challenges around this is, like, obviously these eventually favors the large companies like Google, Facebook, Amazon can afford to hire thousands of lawyers that are going to work around making these ads compliant. Smaller indie creators actually don't have the means to do that kind of thing. And that's obviously one of the challenges that we need to think about when we think about monetizing the web. What I think is good news is, like, we're starting to see the emergence of what I call the membership economy, where basically rather than actually paying or be paid by advertisers, creators are paid by their customers, by the very people that they create content for. And so that's obviously visible through YouTube, for example, is a good platform where you go there and there's more and more you can join channels where you end up paying $5 a month, $2 a month, $1 a month, depending on the options that the creator sets. And then you get special rights on the channel. Medium, a publishing platform that you probably all know of because it's so popular in the crypto space, has this paywall thing where basically, you can pay $5 a month and then you can read all of the content. That aligns incentives between content creators, the platform itself, Medium in that case, and content consumers. Podcasting is a very obvious example as well. Music, over the years, 10 years ago, we were all listening to all of the music for free. And at this point, we all pay for music either through Spotify or some of the other streaming services. Netflix is another example of this, where you would download all of the videos in the world about 10 years ago. And at this point, we just have subscription because it's so easy, convenient. And we actually get good content using this rather than the bad TV that we get for free with 1,000 interruptions. Another big example that I like very much these days is the idea of newsletters. You probably know of Substack. There's a ton of people also in the crypto space that are using platforms like Substack to basically sell access to their brains in some way, like selling access to their thinking, their ideas, their processes. Pump, obviously you probably know of him, actually does that, and I think that's a smart thing to do. Generally, the publisher space is full of people moving to paywalls. Financial Times is a good example. New York Times is a good example. What I want to insist on is that in the end, when people pay for things, and pay doesn't have to be a lot of money, and that we can come back to that afterwards, pay for things, in the end, you align incentives. Basically, if I pay a restaurant to serve me great food, I know that they're actually not going to serve somebody else or putting some weird food in it because somebody else is paying them for that. In that case, it's the same. If you pay publishers, if you pay creators to create value for you, they're going to create value for you, not from some kind of third party that's paying for your private data, for your attention, or any other incentives that they might have that are not aligned with yours. Luckily, I think one of the great things about the crypto and blockchain ecosystem, and specifically Ethereum, is that it can bring a lot of transparency around these memberships and a lot of convenience around stuff that can be done. I'm going to do a quick demo, maybe not the Forbes one. A couple of weeks ago, we launched a partnership with Forbes, the large publisher here in the US, where you could actually unlock an ad-free experience on their website using your crypto wallet. I'm maybe going to do a demo that is more DeFi-centric. So let me see if I can share my screen share. If I maybe reduce that. You probably know of Chris Black. Actually, let me refresh. Chris Black is obviously doing amazing content about DeFi. And a couple of weeks ago, he added a bunch of locks to some of his videos. I'm going to decline that. And so basically, Chris added a lock to the videos, and he did a video on Chai to explain how Chai works, what's the interest rate, and things like this. And so this video is actually locked. And so easily, he put a lock using unlock on the website, and you pay 2 DAI to get access to this video for 7 days. That's what I'm going to do here. My MetaMask is going to pop up, as you can see. Say, hey, do you allow Chris to spend your DAI? I'm going to say yes. And then do you actually want to purchase a membership for Chris's content? Gas is extremely high today, but you know what? I'll actually make it very, very slow. Well, we can actually make it even slower. Wow, it's insane. I don't know what's going on here. But basically, I'll pay the minimum amount of gas because there's no reason to do so. And immediately, you'll see that the content has been unlocked. I can actually now immediately start to play Chris's video and learn about Chai, if that makes sense. So, and I can hear. So that's the idea that in the end, on the web, you'll be able to kind of easily unlock content, services, features. Yesterday, another tool that we love very much, DeFi Pulse, has been using Unlock on their website to allow people to submit their own tokens in their project. It's same idea. You don't have to create accounts. You don't have to kind of submit private information. You don't have to do anything special. You can easily show up with your wallet, pay the required amount, which is literally sending a transaction, Ethereum transaction, as you know. You can choose DAI, USDC, Ether, any ERC20 as a matter of fact. And once you've paid, immediately you get access to the content, which I think is extremely powerful and a way to make things much, much better on the web. Let me go back to the presentation now that you've seen that demo. One thing that is maybe not obvious when you do demo is like when you unlock content, the thing that you receive, a proof of unlocking in some way, is a non-fungible token. It's an NFT that sits in your wallet and that can be used like any other NFT that you might have. And so you can sell it on OpenSea, you can transfer, you view it on OpenSea first, and then you can actually transfer it. So that means that, for example, my Chris Black membership to his blog to learn about Chai, once I've watched this video, maybe I can actually send it or sell it to somebody else. So I can say, hey, Victor, you want to learn about Chai more? I'm sure you know a lot about Chai, but assuming you might want to learn about Chai more, then I could sell you that membership, and then you would be able to access that content. What's really, really cool about this is, like, in that case, Chris Black could actually say, hey, you know what? I'm fine with you sharing that membership, but I want to take a little fee the transfer. So I would pay Chris the right to transfer my membership to Victor, probably less than the full membership. Otherwise, Victor would just purchase the new membership. But that's actually a way for Chris to actually monetize the secondary market. And that's the first time really that creators can monetize secondary market. If you think about artists, generally they sell their art once, and then it's actually whoever owns it, we can sell it at a higher price. With memberships like Unlock, you can actually now monetize on every transfer of the membership. Really what I want to insist on is like the membership economy in the end can be completely decentralized, permissionless, thanks to blockchain, programmable. And that's actually a very critical element of what I'm describing here. Like the NFTs obviously have metadata and can be used in many different contexts. So you can say, hey, only the members of Chris can actually unlock my own blog, or assuming Zapper adds a lock to some of their stuff. They say, hey, if you've got a membership to Chris Black, you're going to get a discount on some of the content that you publish, or that kind of thing. Or you can imagine like pools where rather than actually paying fee per transfer or per transaction, you have basically a membership to the pool that you pay upfront, and then you would not pay fees for any of the transfer or any of the transaction that you might send for a month, a week, a day, a year, that kind of thing. Like BNB, which is Binance's token, is actually a similar kind of play where basically if you own BNB tokens, you're not going to pay as many fees as you would have without it. Generally, I think also one of the critical aspects of all of this is that it's actually very fun. Like it's very programmable. Like the idea of Legos, obviously this is a toy, and when you play with these kind of thing and you start building interesting new behaviors, new usages, that end up actually being extremely fun and pretty exciting. So yeah, that's pretty much about Unlock. Please reach out to me on GitHub, on Twitter at any point, and we'd love to hear from you.
Julien, thanks so much. That was great. Patrick from Outlet Finance, you want to go next?
Yeah, it sounds good. Here, let me just share my screen really quick. We can get going. Awesome. So I'm going to try to make this quick and really concise as to what it is we do and why we do it and who we are. So we are Outlet Finance, and we are building essentially the ultimate passive income tool for the whole world. We really define our app as the app that makes dollars worth saving. Right now, we are built on top of CeFi and DeFi products, and we are an aggregator between the two, and we are meant for entirely non-crypto people. So in order to convey a lot of trust, I think it makes sense to kind of explain who we are and kind of the backgrounds that we come from. So I'm Pat, I'm the CEO. I've been a founder a couple times over. And Chris is our CTO, and we've launched products in the past together. Chris was a former developer at Gemini, helped build their mobile app. And kind of to go into the problem that we're solving for people, the real problem is if you use your bank account, your savings account, or traditional financial products, you're really not going to beat the rate of inflation, especially right now in this time where the Fed's kind of printing money like crazy. The rate of inflation is going to be higher than it has likely this year than it was in the past 10 years. So the fundamental issue is this: savings is actually losing money. So Outlet comes in as a unique value prop to these types of people who aren't exposed to traditional wealth creation tools or really need a way to make money as well as save. So traditional financial accounts, you either have one or the other, right? You either maximize for security or you maximize for yield. The issue is people, really only half of America actively invest in the stock market, despite having the greatest 10-year bull run in history. So why is that, right? It's fundamentally because they don't want to see their money go up and down. They are really, generally speaking, they're really afraid to go ahead and invest, even though there are people who actively can do so. So what we're solving for people is the fact that in a typical account, you either have a 0% interest rate, you can either possibly risk to own, so losing that principal value, or you can do something like a lock to earn. So something like a CD where you lose your liquidity and you possibly do have penalties when you need your money. Right, so you can think of something even like a 401k. You have penalties when it is that you want to early withdraw upon the agreed upon terms of that financial product. So the vision for the product that we have is we want to put passive income in the hands of everyone entirely on autopilot. So we go out, we maximize yield, and more efficiently allocate capital to the best protocols and products on the market while minimizing the risk involved in doing so. We give everyone the entire experience, everything you need to get started. It's so simple, you don't even know that it's crypto. And this is kind of how we think about our competition right now. So, sorry about that. So this is really how we think about, this is how we think about, something keeps happening here. This is how we think about really our competition and who we're building against. So generally speaking, there's a bunch of different bank accounts on the market. Everyone's kind of heard about a lot of these accounts here. And these accounts are generally have issues for traditional people every single step of the way. They either have fees that are happening monthly, even if you do not know about it. So the average bank account fee actually costs the average American roughly $13 per month, even though they aren't necessarily able to save with it, right? So these types of people here, they are facing fees because they don't meet the minimum balance involved, or essentially they are overusing their savings account, meaning that they can withdraw only roughly 6 times a month, which really just doesn't generally work for the large population. So at Outlet, we're currently paying a steady 6% rate for all of our users. Despite in the state of Texas and Rhode Island right now. But generally speaking, the average savings account right now pays out something like 0.09% on it with fees. And there's problems a bit every single step of the way. There's either fees involved, low rates, low liquidity for your money, and issues. So the solution we have for these people is generally this. We have a product right here, Outlet, and we go in and we efficiently allocate capital between different lending protocols as well as CeFi products. So right now, this is kind of a general synopsis on how this product works. It's generally speaking, we go in and we efficiently allocate the capital to the CeFi products and DeFi products that we have coverage against. And if we do not have coverage, what we do is we basket funds to mitigate the risk involved in doing so. So the reason why people are really flooding to us right now in the traditional audience is the fact that these lending protocols really don't have a drawdown. And a drawdown is kind of defined as watching your money go up and down, similar to the stock market. So being a product that's tailored to people that aren't actively investing in stock markets and equities, we really are finding a lot of success in doing so and finding tremendous growth with the launch of V2, which boosted our rates. And I'm going to get into that in just a second. So a quick demo on our product and how it looks. The traditional front end is something like this here. You can go ahead, just transfer your money. Your money's right on its way. This is how the product looks. It's super simple. Don't even know that it's crypto. There's no fees, no minimums whatsoever. So the thing that we're really excited about is the release of Outlet V2 and what it is that we're gearing up for, as well as have officially released in the App Store today. So we have all of our new partners that we've talked about. Without going into detail, a lot of people on this call I'm sure are going to likely know who we're using, but it aggregates between CeFi and DeFi as well, which is why our rate is at a steady 6% offering. So in V2, we've made the app much smoother, and we're also gearing up for something that we're calling the App Store for Yield. So essentially, this is going to feel like a robo-advisor, traditional people. However, it's really going to be a way for you to allocate capital yourself more efficiently and do it as whatever it is that you really want to do. So if you want to go ahead and back some real estate loans, some tokenized real estate loans, go ahead and do so. We're basically integrating a bunch of different projects, and I'll get into a little bit in the future as to what it takes to possibly get your project integrated into Outlet and be in our App Store. So another thing we're excited about in V2 is our goals feature that we're launching. Our goals is going to really tie well into our robo-advisor. We're going to help people more efficiently hit goals for themselves, whether it's just to hit $10,000 in their account, or if it's to go ahead and go on vacation and spend their money however it is that they wish to do so. So another thing we've been doing as well is working with more traditional wealth advisors to bring the traditional audience to products like these infrastructure related products, stuff as Compound, etc. Another thing we're working on lately has been instant transfers. Instant transfers meaning you put money on, a couple minutes later, it's right on the app, earning interest right away. That should be coming out actually, probably on Monday, and we're really excited about it. We also have a general wire transfers feature. So we're enabling larger amounts of money to get onto the app at a more quicker pace. Right now, we do have transfer limits of $2,500 a week. So essentially, with this new wire transfer feature, we'll be able to have more institutional type of clients. So some questions I think people might have on this call, if other founders and people are looking into this. So what does it take to get added to Outlet? And the answer is we need to make sure things are secure, both for our customers' perspective as well as our own. And I think you should as well, just for your project's sake. So that entails a full audit from some type of accredited auditor, as well as like potentially if it's fully built in DeFi, I would think that you would buy some type of coverage for our users on behalf of Nexus Mutual. We have the liquidity to bring a massive value to your project as well. Right now, we manage over $1 million, and funds are protected essentially. The traditional cash account experience is protected, one through Nexus Mutual, and it's also basketed between CeFi and DeFi products. So when if something were to go south, you wouldn't lose all of your money in any circumstance at all, unless there's some type of crazy catastrophic event and everyone got hacked. But that's likely never going to happen. So that's generally what we're excited about, what we've been building, what we're building for, and what we're building toward. So with that, that's about it that we have right now.
Thanks so much, Pat. That was great. Victor, you'll be next.
All right. Well, thanks, Ethereal. My name is Victor Rortvedt. I work on ArTrees, and I am very excited to be sharing some lessons learned from this experience, and also be a part of a panel with some of those purveyors. Wait, is that second, everybody? Okay. Are we seeing slides?
I'm seeing a white line in the middle of the screen.
Okay, let me stop for a second and reset this. I'm trying to share a Figma app. I don't know if that's going to work. I've never tried this before. Anybody see a slide?
There you go. Yep, we can see.
Okay.
I can see ArTrees, so we're good to go.
You see ArTrees, or you see? Does it say spendless giving?
No, yeah, I'm kidding. I'm seeing the cool animated trees that you guys have on the website. Yeah, that's great.
Okay, great, excellent. All right, so yeah, once again, I'm Victor Rortvedt, along with Patrick Adas and Patrick Gallagher. We created ArTrees, and I want to talk a little bit about it, and also about the sort of concept behind ArTrees and where we think this sort of space can go. So I'm very excited about it. So what I want to talk about, the name here is spendless giving with DeFi. And I think some people say no loss. That doesn't really work for me as much. I think spendless is a better term because no loss seems to imply a negative quality, and spendless slightly so too, but this is really a new way of interacting with money. And I think that's really the key thing. It's not sort of doing things normally, but it doesn't have some sort of negative connotation. It really is enabling an entirely new form of financial interaction. But let me describe what I'm talking about. So ArTrees sits at the intersection between charity and DeFi. And so the charity that we paired with for ArTrees is Trees for the Future. And what we're doing here is we're using DeFi protocols to take users' DAI that they have in their wallets, and they keep that, but they can invest that DAI into a lending protocol, earn interest on it, and then donate only the interest to a recipient that they choose. And they remain in control of the process the entire time. They can redeem for DAI whenever they want. And this is enabled by a DeFi protocol called rDAI. And rDAI is built on top of two other protocols. We have the Money Legos thing very much built into the nature of rDAI here because it sits on top of DAI, no big surprise, and Compound. And then it adds the step of being able to redirect where the interest is flowing. For those of you that aren't familiar with Compound, it allows you to earn interest on your DAI. It's like a DeFi version of savings or interest in your savings account from a bank. But the innovation of our DAI is that you get to choose where that interest goes. And so the idea there was there from the start of our DAI. We didn't come up with the idea of donating the interest to charity, but what we wanted to do with ArTrees was make something that was a pretty delightful user interface and that shrunk all the design space and all these, unbelievable cosmic powers of DeFi down to a really, really specific use. To say to the user, we know you can do all these things with it, but let's just give you one elegant experience to do a single thing with it that has some real world utility. So what the site looks like is this, and you have just 3 options. And what it's doing is deciding how many trees per year you want to plant out of interest. And our partner Trees for the Future is able to donate or plant 10 trees for every dollar or DAI of interest generated. So what we have here is essentially $1 of interest, $3 of interest, or $10 of interest per year. We'll plant 10, 30, or 100 trees. And then it looks up what the current rate on compound is for interest on DAI. And it figures out how much DAI you need to set aside and activate to be able to generate that much interest. So it's looking at that in real time. That's not a promise that you're going to plant that much because the rates can go up and down throughout the year, but it gets you started. And so once you have decided you want to do that, it takes you to a Grove page where you can watch the virtual impact of what you're doing in real time. You can see the trees growing. We have these goofy digital ArTrees that are representations of real trees, which are a representation of the impact of donating to Trees for the Future here. So you can see that you've planted this many. You can see what the rate that you're planting at is going to plant over a year with the amount of DAI that you've activated. And then you also have the ability to add some power-ups here, water, fertilizer, or private sun to boost the impact of how many trees you're planting from interest. And again, this is just interest. This is spendless giving where you always keep the money that you started with, the DAI that you initially allocated, and you can claim that back at any time. And the only effect of that would be that the interest stops flowing to the charity. So to date, now we launched this 4 months ago in mid-January, and without anybody spending one DAI cent, 1,600 trees have been planted for free. We've got 100 users of people that have just decided to donate interest out of the good of their heart, or they just want to try out something cool on DeFi. We don't have a massive marketing campaign. This is just people that thought it was cool and wanted to contribute. And there's currently about 8,000 DAI in there that are currently planting trees. Most users have engaged in more than one transaction where they mint more DAI or activate more RDAI to be able to donate more trees and plant more trees, about 2.5 per user. And then we also noticed something that's really encouraging here about the long-term changes that this can kind of affect, and that's that spendless giving is resilient. So I don't know if anybody's been aware, but I've been told that the DeFi space has gone through a period of some volatility over the last several months, Black Thursday being one of the major ones there. And so we've had some pretty serious changes in the amount of demand for DAI and the interest rates. During these 4 months, we've seen DAI interest rates on compound above 20% and below 1%. Which is a pretty staggering amount of volatility in those interest rates. Yet, throughout all that, 2/3 of the people that have ever used ArTrees, even once, are still sending the interest of the amount that they initially contributed to Trees for the Future. So this is encouraging because what it shows you is that people don't really need that money back right away, and they're not feeling any pain from it, but it still is contributing to a really positive cause here in planting real trees. So you can see the chart here of how much DAI has been active in ArTrees over time, and you can see that it's continued to grow for the most part, and that in about mid-March you see a little bit of a drop-off, and that's Black Thursday, but it didn't go to nothing. People, the majority of people still kept it in there. So that's a very encouraging sign that I think kind of is one of the theses that we had when we were thinking about what to do with RDAI programmable interest protocols, that the thought was that people would set it and forget it. And that way it would sort of continue to generate some impact for the cause that they're supporting. And that's been borne out so far. The other thing that's really key about this is thinking about it from the perspective of the donor, of the user. And that's that programmable interest really kind of hacks the psychology of money. So human beings are not rational computers, right? We don't have this ability to think about what is the most rational thing to do with our money. We have a number of cognitive biases that have been studied and have been reinforced, that we understand that this affects the way that we behave. And a number of these cognitive biases are very much tied to our behavior around money. And so one of these in particular is called loss aversion. And so what programmable interest does is it kind of gets around loss aversion. Drake doesn't care about it anymore. Loss aversion, to go into a little bit of a description here, is the idea that losing money feels more painful than gaining the equivalent amount. Scientists have estimated that it's about twice as painful to lose $20 as it feels good to gain $20. And this is called loss aversion. And anytime you make a purchase, anytime you pay for anything, you have to overcome loss aversion because your balance decrements by the amount that you paid. And it's part of an out-of-pocket transaction that the entire economy appears to be based on. But with programmable interest, Drake is happy because numbers never go down. You keep in your balance whatever you started with, and you're still able to essentially buy things for free. It's a magical experience for users, or we hope it will be, because you don't have a large experience with depending on interest, and especially you don't have the same sort of investment in the future income from interest that you do in the current number that represents your account balance. And so when you don't have to have that number go down, but you can still engage in economic transactions, there's a really magical thing happening. And on the other side of it, it's not magical in the sense of being fictional for the recipients. Here, Trees for the Future is actually getting money that they're able to plant trees with. And so they have a vital new capacity to unlock new streams of revenue and to open up new channels of the digital economy that aren't just based on, hey, it's a new tool. It's based on an entirely different psychological process that lowers the thresholds or the obstacles to people wanting to engage in economic transactions. So I think DeFi, and there's a lot of other folks on this call, Julien's talk was particularly inspirational on this too, is really trying to find all these like nooks and crannies of ways that we're stopped from doing the things that we should be able to do with money. And DeFi is unlocking those capabilities and giving them to whoever wants to deploy them. And as much as I love Unlock, and I think it's wonderful, I think we're really at the very, 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 very top of this process. We have not scratched the surface of the types of things you can do when you've changed the psychological calculus to economic transactions like DeFi is able to. And so in some ways, programmable interest is revolutionary when we really think about the consequences of this over a wider span, because we love ArTrees and we think it's a really vital thing, but this is not limited to spendless giving. This is not limited to planting trees. This is about changing an economic pattern. And to sort of describe a little bit more about what I mean, I kind of want to talk about what the world that we currently inhabit is like. And it's this thing that we take for granted. And so there's a cartoon here. This is based on David Foster Wallace's speech, This is Water, from a speech he gave in 2005. And I'll explain it in a second, but there's a cartoon here about an older fish swims by a pair of younger fish, says, hey, how's the water? Hey, morning, boys, how's the water? And the fish take a second, they look at each other and they say, what the hell is water? And by that, they mean they have no idea what it is that is so ubiquitous and that they've taken for granted their entire lives that they don't see it as a distinct substance that has any alternative. And I think what I want to say, the analogy is here, is the water in our world is an out-of-pocket economy. Anytime you pay for something, your financial power decrements to the exact amount that you pay for something out of pocket, and that there's no way to avoid all the cognitive biases that come with that, but that's the world that we inhabit. And if you think about credit and debt products, they're almost entirely just based around the idea of time traveling, paying out of pocket for something, either making it happen now or in the future. And so the different world that I want to think about is what a spendless economy looks like. If you've got money that's doing work for you, and it's not just doing work in the traditional financial sense of, oh, it's earning interest and then I can redeem that interest and then go, buy a Winnebago with it, but you can actually, like in real time, redirect the streams of interest that you could be earning on something. And this really changes the equation about the value of savings, because I think there's a small percentage of humanity that are essentially Spocks that can understand that saving is good because there's this person that is them in 20 years that's going to want that money more than they do right now. And they're able to defer gratification and sort of move all of their thinking into this future version of themselves. And these people are going to be fine financially. Then there's also a number of people who are very spendthrift and always live for today. But what I think the really exciting opportunity is here is a spendless economy where you're able to use your savings to do things in the here and now, to buy things in the here and now that give you immediate gratification, encourages you to build up your savings. The more of a pot of DAI you got that's in Compound or in an RDAI protocol that's doing things that you want to do, is immediately rewarding. You're not saying I'm paying somebody in 20 years for this. You're getting something for it in a way that I think has a lot more resonance with normal people. And so there's a lot to be explored here, and a lot we can do with exploring the power of money put to use and redirecting the programmable interest. Because just to sort of recap this a little bit, at the top here, we've got the small brain, which is doing things the old way. I'm going to give $100 to a charity that I support, and then that's the end of it, game over, and I'm down $100. The second phase, next we've got, ArTrees donating the programmable interest, which is where we're at today. The next phase after that, we'll need some fixed interest products to be able to do this, but that's coming. They're building them on DeFi right now, is paying for something like Netflix with interest. You could decide I can buy a fixed interest product, and I'm going to take a certain stack of money that pays for my Netflix sustainably, and I'm just going to designate it as my Netflix fund, and it's going to throw off interest, and it's going to pay Netflix, and then that's done. And then you build up another pot that pays for your cell phone bill, and you can start to do this in a kind of a rolling way, and then you can reach an interest-only financial independence. And this is different from the typical definition of financial independence, which is like an estimate usually based on 25 times your annual expenses, right? And this makes all these assumptions about how much you're going to need to draw down and the power of interest and everything like that. And what's different here is interest-only financial independence is the moment where you've got every single one of your expenses, your housing, your food, your transportation, your utilities, are all being paid for out of interest from big pots of savings that you've got. And that's an incredibly powerful thing, because these pots of savings are not locked up. If you have an emergency or some other priority that comes up, you can pull it out and you can spend it, or you can redirect it to something else. But it really encourages saving in a way that I think we're only starting to think about the consequences of. And so I'm really excited about what's going to come out of the DeFi space, what's going to come out of the programmable interest space. But we really do have a pretty exciting opportunity to sort of build an entirely new type of economy that changes the calculus of financial transactions in a way that I think is rewarding to users, to content providers, and that can really be one of the sort of exciting use cases for the Ethereum blockchain and DeFi in general. So what the team that built ArTrees is working on now is something to sort of help bring this about. We're working on a platform that is kind of a sort of sequel / the next phase of what we can do from what we learned from ArTrees, and it's called Spendless. And so if you're interested, we're going to launch sometime this spring. You can go to spendless.io and sign up for our newsletter to keep updated about what we're doing. But we're going to be really excited about what we're going to be launching to sort of take this to the next level. So thanks again to Ethereal. Thanks to all the other presenters. And it's been a really cool, exciting opportunity to share with you this vision of spendless giving and spendless economy. So thanks again, and everybody have a great summit.
Very cool, Victor. That's exciting. Thanks for announcing that too. I didn't know about that. Cool. So we're going to next have Head of Business Development at Loopring, Matthew Finestone.
Okay. Thank you, Travis. And everybody, can you see me okay? Okay, thank you.
Yeah, all good. All good there. We can't see your slides though yet if you're planning to share your screen. Or Loopring. I'm hoping you actually show Loopring just because it's...
I know.
Yeah.
Yes, okay. Sharing. Okay. So, yes, I'm Matthew from Loopring, and Loopring is a open protocol for scalable non-custodial exchanges on Ethereum. And we scale using ZK rollups, which many of the folks in here or the watchers and listeners now and in the future know a lot about. A kind of breakthrough technology of the past couple of years, and specifically the past half year, it seems. But So we build exchanges that try to be as scalable as the real world, or as legacy exchanges, I should say. A quick bit of background just to see where we're coming from, because it really informs where we are right now. We started building DEX protocols, Loopring, in mid-2017. Version 1 was the standard off-chain as much as you can, but on-chain settlement. So the order book is off-chain. And that goes faster than, the pure naive or the first implementation of everything on-chain with order books on-chain. But that even this hybrid model, kind of similar to the 0x model, it was not fast enough, only 2 or 3 trades per second. V2 was similar, plus some kind of fancy functionality. And V3, which we started working on about a year and a half ago, is the ZK rollup. And that was deployed on Ethereum mainnet in December of 2019, and it is Ethereum's first ZK rollup implementation. So just a bit about what is kind of under the Loopring umbrella right now, because it's evolved, is the main thing, and what we've been working on for the almost 3 years, is the open source Loopring protocol and the zero knowledge circuits. So that is the protocol, the logic. Then we have the closed source Loopring relayer and prover. That's the kind of system integrator and snark generator that puts everything together off chain and is kind of operates the system. Anybody could build one to the specification of the protocol, but we have built our own, and it's not an easy undertaking. A lot of people know or kind of have the connotation of relayer being something simple you could spin up, which it is for some projects, but for ours, it's actually it's a relatively heavy duty task to kind of operate the back end of such an exchange. And recently, which Travis just mentioned, we launched our own product atop this stack, our own exchange, loopring.io, which I'll get into a demo as well. I'm going to run through the slides quickly, which kind of shows leading up to the demo. But so our big goal is make Ethereum exchanges the obvious choice for trading. Everyone here probably feels it's the obvious choice for most of their needs, but even between us, sometimes it's not perfect. We have to go outside our plane of existence into the old world if we want to trade quickly or cheaply, and by quickly I don't mean actually DEXs are really simple for trading quickly because there's no logins and stuff like that. But if you want to trade fast, several times per second, high frequency. But yeah, so that we want to make it the obvious choice. And again, for all sorts of trading, not just swapping. We want all sorts of trading to be able to find a home on Ethereum. We view it as the ultimate settlement layer, and we're kind of tired of thinking that it's only good for slow swaps. So we kind of differentiate, or I do in my own head, between simple swaps, which which the DeFi space and our DEX peers are amazing at and have shown amazing track record recently. Uniswap, Kyber, several others, all the DEX aggregators, amazing swapping experience. We want traders to find a home on Ethereum as well. And how? We need to make it indistinguishable, the experience on a DEX versus a SEX, a centralized exchange. It needs to be just completely indistinguishable, to the point where we don't even use the word DEX or non-custodial anymore. If you're trading Ethereum-based assets or real-world assets that are represented on Ethereum, it'll just be obvious that this is happening on Ethereum, not in somebody's database off-chain or strictly in a database. It's going to be, we won't need to use this qualifying word anymore. That's like really the ultimate goal, funny enough. And yeah, it'll just become so obvious. And it's fun. I added this slide just before as DeFi Dad, Travis said at the intro of this 25 minutes ago. It's like Coinbase Pro, but 100% Ethereum security guarantees. That's how I often describe it to somebody in one sentence. They say, hey, what is it? I say, it's like Coinbase Pro or Binance, the old-fashioned order book exchange, full functionality, but 100% Ethereum security guarantees. So thank you, DeFi Dad, for that quote. So high performance DEX trading. Now let's take the point of view from the DEX detractors. And this is their script. We've all seen it on Twitter and everywhere else. These are the 3 points that they mention. DEX trading is too slow, it's too expensive in gas fees, and it's a terrible UX. You combine these and you have basically all their iterations of disparaging remarks. But they've been right to a certain extent, but they might be kind of plugging their ears and blocking their eyes now, because if they're still saying this, they're simply not paying attention, because it's not the case, as we'll see with the demo. But this is a solved problem as it stands right now. So let's look at the Loopring protocol and what it can allow, and you'll see that that those remarks are no longer true. This is what we're going to focus on, this middle column. This is the Loopring ZK rollup protocol with data availability. I don't want to go too much in the nitty gritty, but data availability means the strongest guarantee. It means that you only have to assume Ethereum will exist tomorrow for a user to be able to reclaim their assets, whether an exchange owner becomes malicious or gets regulated into oblivion or runs away or whatever. As long as Ethereum exists, a Loopring protocol-based exchange will be able to give their users back, or not give their users back, the user themselves takes it back. And you see here, and I'm comparing versus Loopring 2.x and prior, but in that bucket of Loopring 2.x is all the other DEXs, as they, like the 0x implementations and Kyber and Uniswap. That first column is how is where they lie as well. You see we've scaled by a factor of 1,000. We could handle 2,000 trades per second as opposed to 2 back in the day. And you see the gas cost is also reduced by almost a factor of 1,000. So 1,000x scalability live right now. That is where we are. I won't talk about the without data availability, which is an option somebody could configure in the protocol, but a ZK rollup, in my opinion, which we'll touch on a bit more, ZK rollup with data availability, that's slightly redundant. A ZK rollup kind of assumes data availability. To call a ZK rollup without data availability might be called a ZK plasma. So ZK rollup is the most secure scaling, layer 2 scaling solution. Or in fact, it's like so secure and so tightly coupled to Ethereum that, as our chief architect recently said, he views it as layer 1.5. Not even layer 2, because we'd kind of be maybe selling ourselves short if we just think about it as layer 2, where there's other security assumptions, maybe some other validators, like on a side chain trying to reach consensus in a different mechanism, or storing data some way off chain. ZK rollup is just Ethereum assumptions. We'd need to introduce nothing else in terms of safety of user assets. So that's what we aim for, and that's what we've built. Just to put it into dollar terms, how much a settlement cost, how much a trade will cost. In the best case scenario, it'll cost this amount, or actually I'm off by 1 decimal there, I realize, but to put it into easier human readable terms, we could settle 1 million trades for $124. That's all in. Gas fee plus prover cost. Yeah, so 1 million trades for 100, that's a really nice operating cost. And here, I took this slide from one of my colleagues. It's a nicer looking slide, as you can see. You see the transaction costs of other DEXs, where they are, and Loopring's settlement cost is barely visible. It's about almost 1,000 times cheaper. And how this all works, very, very briefly, and I'm just going to kind of butcher the explanation, but an exchange state is kept off-chain in a Merkle root, and anytime a trade happens, it's changing one of these leaves, just changing something in the state, which an operator that I mentioned before keeps track of, and then when it has enough changes to the Merkle tree, let's say 1,000 changes to the state, it says, okay, I'm taking these 1,000 things, I'm proving their validity with a snark proof, a validity proof, and I take that proof, which is a thumbprint of this whole exchange state's veracity, and I'm putting that on Ethereum. So that's how it works. Put as much off-chain as possible. prove it with this, mind-bending technology and just put that proof on chain with a little bit of the extra data that allows you to go from state to state. The deltas of each leaf is also put on chain with the proof. That's the data availability I mentioned. So all this magic is ZK rollups. So DEX is scaled today, as I said, so much so that Ethereum is no longer the bottleneck. Who would have thought that? Ethereum is not the bottleneck. As I said, Loopring protocol can do over 2,000 trades per second right now on Ethereum. Our relayer, the off-chain piece that actually updates that Merkle tree so fast and then generates the proof and interacts with Ethereum, our relayer can only do 200 transactions per second. I say only because we still have, we can't keep up with the protocol. The protocol and Ethereum have gone so far that our off-chain kind of legacy piece of infrastructure is struggling to keep up. But hopefully, we'll get there. But as I said, it's no easy task. And this allows for the cheapest trading fees. I'll get to that actually in a second, but you see, we could support 0% maker fees and very cheap taker fees, 6 basis points to 10 basis points on our product. That's not a protocol consideration. So this is a big question, which I actually posed to my compatriots on this chat and all the listeners and just everybody in this space. What type of user is this for? Is this for a DEX user and us DeFi native people that want to go faster and cheaper? Because sometimes we express that need. Or is it for the SEX users, the centralized exchange users, and the legacy traders who want to take control of their funds? It's like, where are we coming from? Both sides. DEX people that want to go fast, or SEX people that want to go safe. And then we're there. It's honestly an open question and to be seen where we will get the bulk of our users. I mean, we've only had one product open for about 2 months now, so we'll see where that comes from. A bit of both, hopefully, is the real answer. But actually, my answer is, practically speaking, who is this for? Right now, programmatic traders that need speed. So algorithmic traders, high-frequency traders, professional traders that might need to do 50 trades per second, 100 trades per second. The way they've been executing their strategy, whether in equities or FX, and now in crypto assets on centralized exchanges. If they want to go super fast, we're actually the only game in town right now. But very happy to see actually in the past recent days, folks like Synthetics, working with Optimism, everyone will eventually come to layer 2. We're just the first ones there, and we do it the ZK way. But others will go on to Starkware and all this awesome stuff, but programmatic traders need this. Not all programmatic traders. Of course, a programmatic trader could program their, maker bot type trades that look at the Uniswap, but where speed and cost is not an issue, is where those types of programmatic traders operate. The legacy type need this. So I actually really urge algos and any type of professional trader to check out this exchange and try to do this trade on Ethereum at the speed as fast as you can. The other type of trader, so we have on one side the real professional traders who, every penny counts. They might be scalping half of a basis point between USDT and DAI, or ETH and DAI. They might be really fine-tuned trading machines. The other type, coincidentally, is traders with small amounts, or kind of like small-time traders. If they want to trade $5 for something, right now on Ethereum, as we see, the gas cost has spiked. It's over 20 Gwei. If they want to trade $5, that might cost them 10% or more. Like, right, to set up my demo that I'm about to do, I have to move around some stuff. I paid a few dollars in trading fees. In network fees and gas to get on there. So traders with small amounts also need to be on a layer 2 if they don't want gas fees to eat into their small amounts. So you kind of have, interestingly enough, both ends of the spectrum may find a home here. And that's actually a really nice recipe for a successful exchange, because the programmatic traders are really price sensitive and they're there with their resting limit orders, trading 100 times a second. And then this trader with a small amount just wants to lift the best offer or hit the best bid, but doesn't want to pay half of their $5 in a gas fee. They'll only pay a trading fee, as I showed you, of 6 basis points. So really nice experience there. Before we get into the demo, really quickly, something I don't usually really talk about until recently is a few business or real world considerations. So not so much on the user front, but on the business operator front. Because remember, Loopring is an open protocol. Anybody could go build an exchange there. Besides the ideological people that maybe were surrounded by too much, that ETH is so great and why would anybody go anywhere else? People say nobody cares about keeping their own custody. Some philosophical reasons may not be enough to convert actual businesses to come build on Loopring and on Ethereum. But we have some really nice practical points to bring them on now. This is a cost-saving technology. As I showed you, an exchange on Loopring can settle 1 million trades for $124. That means they might be able to really reduce or not hire, just keep their headcount really small. They don't need a team of 20 DevOps people keeping users' funds secured on an old custodial exchange model and paying security personnel and compliance personnel and the big headache. Maybe they can't, as Vitalik says, control as a liability. Liabilities mean you have to pay a lot to kind of suppress those liabilities or protect them, whether it's an insurance or whatnot. So actually, this non-custodial exchange technology on Ethereum, not only is it not expensive, as detractors say, it is a cost-saving technology. If you want to build the next Binance or Coinbase Pro, you might very well want to do that on Loopring, on Ethereum, because you could spin up tomorrow without having to hire a big security and engineering team. Similarly enough, this is also a tool and a friend of regulators. A lot of people think that DEXs and DeFi are, kind of no man's land and gray areas and, not exactly a friend of regulators, which could be true. And in the case of the demo we'll see on our product, we don't enforce KYC, for example. But an exchange building on Loopring can decide to put at the front of their exchange some type of gating mechanism, some type of KYC platform that identifies users and via whatever regulatory regime they must follow. And the big thing is they don't have custody of their users' assets. So if they go to a regulator and these regulators are suspicious because $2.5 billion has been hacked from exchanges or hacked inside jobs from exchanges, these guys say, hey, I cannot take my user's funds. My hands are tied. The protocol constrains me. And indeed, actually, in Canada, where I'm from, the Canadian Securities Administrators, the collective body of securities legislators, they put out guidance recently that showed that they want non-custodial exchanges to be the norm, that if you're not a non-custodial exchange, you might be subject to securities legislation, which is very costly. So this could be this is the real business case for it. Businesses will come to Ethereum for the good old-fashioned reasons of cost saving and regulatory reasons. Now, before the final slide here, because the name of this session is money Legos and innovation money Legos, the one thing we must be aware of is everybody here has really nice kind of layer one, beautiful composability, and Legos and all the pieces look the same. But to be honest, a ZK rollup like Loopring, we kind of look the same, but like we're a bit different, and we're looking at like the other Legos and saying, hey, can we play with you guys? But we're still like a bit of an outsider because we exist on this other plane of existence, this other, in the ZK rollup environment, you have to enter the rollup and exit the rollup. So the Legos don't fit exactly, but they will, first of all, with innovations in zero knowledge technology and different curves on Ethereum and stuff like that. But they'll also just naturally, the pieces will start to fit together more. So that is it. I'd like to go into a demo very quickly. Let me go here. Okay, so here we are. This is loopring.io. So let me just show Let's see if it shows any differently. So remember, as Travis said, Coinbase Pro, but completely on Ethereum. Here I am, and I have my MetaMask here. I've never interacted with the exchange. What you'll notice, you have to register an account, which is kind of a bit weird for us DeFi native people who know we just need to bring our wallets to the party and trade very easily. The reason we have to register this account, and you'll see it's not asking me for my name or email. It's only using my Ethereum address, and then it's taking a password, and it's creating a trading key account for me. This is one of these little idiosyncrasies to enter the ZK rollup. In the future, we actually won't need to enter a password, perhaps, because people like MetaMask, tools like MetaMask will be able to support ZK rollup efficient signatures or snark efficient signatures like EDDSA instead of the ECDSA on Ethereum layer 1 right now. So you have to create a password and make and register that, and that does take an on-chain Ethereum transaction. So a bit of to some extent, this is a friction for DeFi native people, but for a legacy style user, they say, oh, a password, that's great. I'm used to passwords. That's really nice to see. But I'm not going to register a new account because it does take an on-chain transaction and the network is very clogged. What I will do is go to an account that I just created right before Ethereal demo. So this one, I did create my account, which again, just requires an Ethereum address. And I'm going to enter my trading password. And I am logged on. And I'm going to go a bit quickly because I realize I was quite long-winded throughout that PowerPoint. But so here I am. You see, you have logged in. Enjoy your custodial and high-performance trading experience. I could switch wallets, etc. And please note, there's no personal information of mine here. There's no. It's just my Ethereum address. Let me go to my account, and you'll see it's very similar to a legacy centralized exchange experience. It's showing me my tokens on Loopring exchange, my tokens of this address on Ethereum, and thus my total value. So you see, to actually get onto the rollup requires this extra step. That is why earlier today I had to deposit money onto the exchange, which takes an on-chain transaction. So just to be clear, whenever you're kind of entering or exiting the rollup, you're subject to normal Ethereum latency and cost. It takes an on-chain transaction. Once you're on the rollup, so you see here, my balance on Loopring, I have 10 USDT and a little bit of Ether. Once you're on here, everything goes at the speed of, the speed of sound, or however snappy we can make it feel, normal internet experience. So let's go to trade really quickly. And so here I am, LRC USDT. USDT is quite a popular pair of ours because we're actually mostly based in Shanghai, our team, and USDT remains very popular in China due to its liquidity. But yeah, you see, we have only a few pairs right now, actually. LRC is Loopring's token versus ETH versus USDT. We have DAI, stuff like that. But let's just show how quick it. So I'm going to buy LRC. So I'm going to buy, and let's do it for 50% of my USDT worth. So here, notice my price here at $0.0336 USDT. When I click buy, immediately I'm added to the order book, and you see in my open orders here that happened instantaneously. Now I'm going to cancel it because I likely won't get filled quick enough. So cancel. Again, no cost here. No cost to place an order, no cost to cancel. Just the legacy experience we're all used to. But to lift, to show you actually a completed transaction here, let me lift the best offer. I don't have enough there, so let me just put it to 75% of my. So I'm going to buy $8 worth of LRC. So I'm going to click buy. And it's filled. My order was submitted. It was filled immediately. It's not resting there. And you see here it was filled. So here I am trading at this, as we're all used to, except there is nothing a malicious exchange operator, a malicious government, a hacker could do to remove a user's assets from their hands. And it has all the functionality you'd expect. And to get my money off the ZK rollup and back into my normal Ethereum address, all it takes is a withdrawal. And that's it. I'll leave it there, guys. Thank you very much.
Hey, thanks so much, Matthew. We'll have Nate go next from Mintbase.
All right, unmuted and setting up my screen. Can you guys hear me? A little nod from someone.
Yeah, you're all good, Nate. Looks great. I can see your screen.
Neat. All right, we're about to go on a little adventure, guys. A good percentage of this is going to be full demo. I'm pretty sure something is going to break, but that's what's fun. I'm going to give you a quick high-level overview of what the heck we're building, but the main point that I want to set home to everybody is that we are not just an NFT minting platform. A lot of people kind of look at us and go, oh, great, cute, another NFT minting platform. What's the big deal? The big deal is we've figured out the token management, and that is really, really, really flipping hard to figure out. But there's a bigger picture behind where we're heading. I'll kind of explain my background and why this is going to start making sense. So my background, I worked with Nike. I got pushed them to overall Nike ID. It's $1 million a day application that basically you can customize your shoe, put your name on it, and do all sorts of fancy things. The really tricky part with this application is the code was garbage. Yeah, well, that's a horrible thing to say. It wasn't garbage. It was just old and it needed to be updated. I also worked for another company called Bump. I was in charge of basically doing the fractionalizing of publicly traded shares when you purchase something with debit or credit cards. So basically, if you swipe your debit or credit card at Starbucks, as a reward, we'll give you 0.0021 shares of Starbucks stock. So I got to really understand how digital assets work. I would actually argue that digital assets don't actually exist without a blockchain. But to go back, what I built is basically a smush between these two things together. It's doing something really complicated in a nice visual way and dealing with digital assets. They're still killing it. I'm an advisor for them, and it's a great company. So digital assets, if you look at the explanation or the definition, it's an asset is anything that can be considered tangible or intangible that produces value that can be owned or controlled. The last two gets a little sticky because when we think of a digital asset, let's think of Facebook shares, right? In reality, I can't control it. I don't have a wallet where I'm like, great, here's my shares. I can send it to my friend. I can send it to whatever exchange I want. In reality, you're dealing with another company, a broker dealer, let's say Robinhood. They became their own clearing firm. Just to simplify it. And then they interact with a clearing firm called Apex Clearing. And they're the ones that actually are the trusted database that says you have 5 shares of stock. So you're dealing with another company on top of another company, and then Apex deals with many more companies behind that, which right now we're dealing with a new world of none of that. We are not a ticketing company, first and foremost. We're kind of becoming the Amazon for digital assets, where anyone can come onto our platform, create their own stores, and kind of our number one selling product is tickets and art, and that's kind of our go-to right now. We have over 600 deployed smart contracts on our system. Over 12,000 unique addresses have touched these tokens, and 35,000 minted tokens. So every single time someone mints a token, they can only mint 25 at a time. Is my screen stuck? Anyone?
Nate, I can see 600 stores, 12,000.
Got it. Cool. So I'm actually going to go into this thing and spend the rest of my time looking at stuff. So if I go into Mintbase, so right now everything that we're about to see is rinkeby.mintbase.io. This is completely synced up with our mainnet. So if you went to mintbase.io, that's all obviously mainnet. So these numbers are all Rinkeby numbers. If I actually went, you would see the 600 stores. But let's go and sign into the system. So I'm already logged in. I'm actually gonna log out so you can see what it looks like. You can use Fortmatic, easy onboarding, Coinbase wallet. It's the Coinbase link, Wallet Connect. Everyone's used to that with Arjun. We're gonna do MetaMask just to get it going. So once we hop in here, basically this is my splash page where I get all my non-fungible tokens. We launched with Metacartel Demo Day with Peter. We did the tickets for that. It was one of the largest NFT-only ticket events back in the day. So I'm going to go into my builder. This is my store. Each one of these are individually deployed smart contracts. If I want to create a whole new store, I'd come in here, stick in what the name of it is, what the ticker symbol. As soon as I would hit that, it would then create my store. If I want to mint a new token, let's say we have 32 of these, we'd come in here. We got all these beautiful little dials and minting things. Maybe we want to just go ahead and click mint. And what's quite neat is that, so we just had 32 of these minted. We don't hold the users up for transactions. So basically we just went behind the scenes. So that 32 should pop up as soon as the confirmation goes through. Let's see it go through. Well, just believe me. So there it is, 44. So if we want to transfer these tokens, you can send all your non-fungible tokens directly to me. We can send multiples to different addresses. You click transfer and off they go. If you want to mint a token from scratch, let's go ahead and maybe we create a new store. Let's get that in the process. We're going to deploy our own smart contract. It's pending. As soon as that goes and confirms, it'll basically redirect me. But what's really neat is that everything runs off of the graph. So our entire interface, as soon as you saw that number update, it's because we're using our graph. So you can come in here, you can see all of our store numbers up to date. You can see that 600. If I go into mintbase.io, all numbers align here. So you can use polling and you can get that real-time data. Anytime you want to actually interact with any of these contracts, you can just come into our docs. Whoops. Getting out of control here. Let's see. All right, so we just deployed this contract. So Ethereal, if we want to mint a brand new token on here, we could come in here. Let's say we have, I don't know, a week membership at Full Node in Berlin. That's where we've been building a lot of this stuff. Maybe a week. Does some stuff, set a price, off it goes. And there it goes. So as soon as it confirms, you'll see it update directly in here. So there it is, ta-da, we have our app. So what's really neat too is if we go into OpenSea, they take a little bit of time. Let's see. But it should just pop up directly here as soon as the blockchain confirms. This is kind of that time when I think people start getting, oh, this is what blockchain does. I can move my assets around and go from there. So what is this? What's like the bigger vision, right? So if we go into, let's see, the entire Full Node store, we can tokenize a lot of things. It's not just art or photography. We can actually check people in at places. So the biggest news that we have is that we just switched to fiat. So here's DAppCon. It's going to be a very large event, still physical. And we can come in here and you can see buying crypto. So as soon as we click buying crypto, we actually have our embedded market come in. So what's really fascinating here is, whoa, we got credit debit. So let's say, I think we do this really the right way. We allow you to have any wallet you want. We verify the email. And then as soon as that plugs in, and then you pay it. I can actually show you the purchasing process on my local machine, so I don't show you guys any of my card numbers. This is all testing data. Let's go here. Nothing's broken yet. I'm pretty excited about that. Let's see, how much more time do I have?
Nate, if you can wrap up in just two minutes or so, if that's okay.
2 minutes, I could definitely do that. Okay,
Awesome.
so let's log out. Let's actually do a credit card payment with one of my stores. So here we are. Since I'm the owner of the non-fungible token, I can actually come in here and see that my Stripe has a connected account. And once that's connected, I can actually enable certain stores to be enabled. And once they get enabled, then all of a sudden, yep, you can do that. I think that's all she wrote. So take it away. Go for it, DeFi Dad. You're good to go.
Thanks so much, Nate. Sorry, I was on mute there. Yeah, so next up we'll have Alex from PieDAO join us.
Hey guys, what's up? Thanks for having me. Thanks Travis for inviting me. I'm actually thinking gonna put out my video because it's been a little bit funky lately, but can you see my screen? I'm gonna take that as a yes. All right, cool. All right, guys, I'm Alessio from PieDAO, and today I'm gonna speak a little bit about this idea of building tokenized diversified portfolio to reduce the risk of holding crypto asset. And I kind of want to start from here. So one of the things that I think it's very interesting about Bitcoin and and DeFi, like in general, is that it's really been introducing maybe an entire generation of first-time investors like to a lot of economical concept. I think now we have a little bit of more clear data in terms of what DeFi user looks like, what crypto user looks like, and in that regard, I think we know that the vast majority of DeFi users, for instance, have nothing to do with finance. So that's great, but in that regard, obviously, like one of the first concept that people come across when they get acquainted with economic concept is obviously risk. And obviously there is no free lunch in finance in the same way there is no free lunch in crypto, but there are a number of different risks. Some people might argue that they are even more, especially in the DeFi space. Now, when we talk about risk in terms of DeFi, sometimes we talk about different nature of risk, that being like security or smart contract bugs. Sometimes we talk about platform risk. But from a pure portfolio perspective, I think a very easy way to think about it is related to price. So in the context of this talk, I think we can very, very simply define, risk as pretty much, the volatility of price over a specified period of time. And obviously in that regard, risk is dynamic in its own nature, which means it can change over time. And also the perception of that risk will eventually change and be reflected through the market price. And the very simple rule, if we take everything out, is that, if risk goes up, then prices go down. And if risk goes down, prices go up. It's really as simple as that. Now, this can be good for some people, especially if you are a speculator. But since crypto is a very new kind of asset class, it's not, it's also extremely volatile, which means it's not uncommon to see, 50%, sometimes 65% swings in either direction, up or down. And, if you're one of those, first-time investors, then it can become, pretty stressful to hold tokens. And sometimes this can lead to very, very bad choices, as we haven't seen in the last couple of years. Now, obviously, you could try to become an active trader and eventually, trying to time the market. But if you are in that stage of being a first-time investor, the possibility for the outcome to be positive in that regard, it's usually very low. So generally speaking, I believe there is, a better answer to this problem. And that's actually an easy answer. That being, bringing tokenized asset allocation as a financial primitive of DeFi. Or, in a more funky way that I like to call it, pretty much building, one token to rule them all. And, when you think about this magical token, what we're really describing is pretty much a buy and hold strategy that, allocates your asset in a way that, should help you get through different type of market regimes. And in the next few minutes, I would like to, kind of share the idea of how I think, that might look like if, let's say, we call this token kind of a magic token, and, how might become a reality like in the near future. And in order to do that, I want to start by sharing a couple of specifications or rules about, my dream tokenized portfolio looks like. And they are very simple rules. Like the first one is, I want, this asset allocation to automatically rebalance by themselves. And the reason why I want that, I think, it's pretty simple, is that, rebalancing obviously ensures that my portfolio remains diversified, which in the long term, will help me mitigate the overall portfolio risk. And the second rule is that, I love Ethereum. I think it's great. But from a pure portfolio perspective, I don't want to, to take a winner, or to keep a winner, at least not yet, right? So I want to get broad exposure to a variety of different layer one token, that including Bitcoin, or maybe, even some more. And then the third simple rule that I want to comply is, I would ideally like to, to have some exposure to different asset classes which have nothing to do with crypto whatsoever. And the reason why is, crypto assets tend to be very much correlated between each other. And then the fourth, which is the most subjective rule, I really want this to be built on Ethereum. And the reason is Ethereum is so awesome. And then once you get a near C20 compliant token, you can do so many things, which is, I really want to be built in Ethereum. So let's start from the rebalancing part, and the way we are gonna do that to start building our my magic token is from a balancer pool. Now, if you are unfamiliar with what balancer is, just to say it very quickly, it's a multi-dimensional automated market making platform, and you can translate that for human, you can think about balancer pool as pretty much of a portfolio where you can put a bunch of different assets with different weights, and you collect fees from traders which are actually rebalancing your portfolio continuously. So it's a very cool platform. I really like it. We've been working with these guys for a very long time. So if you don't know, go and check it out. Now, you can take this balancer pool, and if you're like me, you want to add a bunch of different extra security features. And there are a number of reasons why I think they should be there. If you want to kind of dive a little bit more into the detail, I think last week I did a longer talk of why we need circuit breaker in DeFi. But the basic idea is that we want to add a bunch of different circuit breaker. We have, you might want to add security features in so that if one of the assets within the pool is at risk of defaulting, or it maybe is frozen in transfer, something that, for instance, happened recently with AMBTC, you can still get out all the other tokens in the pools. And you want to have usability features, including custom tickers, custom curves for the pool, and DAO management. Now, if you did all of that, then you end up basically having a pie, and which is great. So now you have this magic box where you can put your token in, which has security mechanism in place, and that will automatically rebalance all your portfolio, and you even get paid in the process of doing that because of the trading fees. Pretty nice. So first rule is kind of done. Now let's move to the second one. Now the second one is a bit tricky because obviously there is no simple or native solution to make two different blockchains really talk between each other. That being said, luckily, DeFi as an industry has been evolving quite a lot. And lately we have been seeing a number of different projects that really are working to bring exposure to other layer one tokens in the form of ERC20, and there is a wide spectrum of different projects doing that, from the more centralized one, as you might know, WBTC or MBTC to more decentralized one. Very recently, Keep Network has been coming to mainnet with TBTC, a REN protocol as well. And then you have, even completely synthetic solution that give you exposure to that. So that's pretty great. And now, you can even try to apply like the same rules for the Dream portfolio to this solution. And then if you do that, you're basically putting them into a pie, and that's pretty much what BTC++ looks like. It's like a weighted allocation, which gives you, diversified exposure between the different representation of Bitcoin and on Ethereum. And it's been working fairly well so far. I'm quite happy with it. I think we're about to cross alpha million right now. So that's great. And then so we have kind of a solution to get, that kind of exposure in IRC20 way. Now it's kind of reasonable to think that, over time, we are going to see a number of other tokens coming into the Ethereum network in the form of representation of ERC20, such as, Litecoin, XRP, maybe even Bitcoin Cash. So it would be only natural that, you do like a step forward in order to make, a more complex allocation using all of these that you might call like a large cap allocation, right? Something like a large cap pie. And I really don't want to focus on the allocation itself, more on the context, more on the concept right now. Like it will seem like a very natural step to do. And obviously, as we are DeFi people, like we can even make a step forward and say, we really want to get, DeFi exposure in this thing. So maybe what we can do is to, create a separate DeFi pie with diversified exposure on all the DeFi tokens, and then bundle the two together into what we can call, a crypto exposure pie. Okay, that's nice. So we kind of covered like the point number 2. So now we can get diversified exposure to settlement layers, but also to DeFi, all in a single token. That's nice. And now we have to go to the third point. Now the third point, it's kind of tricky again. Like the reasons why we want that, I think, are very clear to everyone. We want to get some other kind of asset class into our own portfolio, such as gold, oil, silver, maybe equity, like all these kind of things, because all the crypto assets are very much correlated between each other. Now, luckily again, DeFi, it's here to help. And we've been seeing like a number of different projects, the most famous one being Synthetics and UMA protocol, which are working to provide solutions to get the price exposure through completely synthetic asset. So, and that's something I'm very excited about. Generally speaking, I don't think we're gonna see real traditional asset anytime soon coming into DeFi. So synthetic asset is kind of the solution to that. Now, once that happens, well, it's only reasonable to bundle them together into into their own pie. And by doing that, you kind of get this double exposure and this double benefit of doing that, because as many traditional investors have been looking into crypto as an edge for going against the systemic risk of the entire market, like the banking and money printing going brr and all this kind of stuff. On the other side, you also don't want to be fully vertical on a single industry. So having that kind of makes a lot of sense, as a very well structured portfolio should really offer like a wide range of options. So now we have that, and I think we are going to have that like very soon with a number of different tokens. So we should have pretty much all the different ingredients to build our own magic token 0.1, and we can kind of look at how that looks like in the end. I think it's pretty interesting. Like it's a permissionless ERC20 token. It's completely non-custodial because we've been using only DeFi native stuff, which is great. It's also a portfolio which is available globally 24/7 and pretty much at no minimum. So you can think to kind of onboard yourself starting from a few cents of a DAI, like on Uniswap or something like that, which is great. It gives you pretty much broad exposure to well, I wouldn't say the entire, but like a large part of the crypto market, and also to DeFi, while also offering exposure to other asset class in terms of price, like equity, commodities, and treasury bills. And also, you don't have to worry about it in terms of rebalancing, because as a matter of fact, you rebalance automatically through or thanks to the automated market making offered by the underlying technology. Now, since these solutions are very much flexible, like I can definitely see even some evolution of it, like in the near future. I think like the composability of aspect of this price is very important, because it's very easy to take all these core pieces and bundle them together for very specific use case. And sometimes I think about that. I think they will be like a great source of collateral, which is like, if you think about it, it might be even what MakerDAO is trying to achieve right now by diversifying the collateral aspect on which you can mint DAI, which is pretty great. And I'm pretty sure like that we're gonna see anytime soon solutions to offer 100% coverage of insurance that you can even bundle into the pie itself. So you might end up having an allocation which is also 100% insured, which I think will be pretty great. So to wrap this up, a few conclusions. I think we are at the verge of a new era of digital tokens, and I think this solution will eventually absorb like a massive amount of passive capital, as we have been seeing in similarly like in traditional markets through passive instruments like ETF and index mutual fund. I think there will be a special spot for having specific curves operating in the underlying AMM technology of a specific SPY, and some of this optimization I think will really make the difference. And and variation like will be very easy to make as long as we have core ingredients. Setting that up like in slightly different allocation will be pretty easy, and I'm convinced we're gonna see very specific use cases being created with all these core pieces. And then like a note of caution before we close, obviously all the diversified portfolio have inherent risk, and they will go down in value. So even if asset allocation can probably to some degree reduce the probability of a large loss, and perhaps even sometimes the frequency of those losing periods, this is in no way a way to eliminate portfolio risk in their totality. But I think it's a step forward, and I think new users of DeFi will eventually benefit from it quite a lot. So I'm gonna wrap this up. Like if you have questions about this entire concept, please feel free to reach out on Twitter at Alexintosh or tag PieDAO_DeFi. I don't know if you're doing Q&A. Otherwise, Travis, I'll leave it to you. I think Travis is on mute.
Hey, thanks so much, Alex. Sorry, again, I keep going on mute here. Arjun, you will be our final talk for today.
Awesome. Thanks, Travis. All right, I'm gonna share. Cool. Can everyone see my screen?
Yeah, looks great, Arjun. There we go, I can see it.
So a quick disclaimer before I get started. This talk is slightly less about DeFi. We're working with some projects that are doing more stuff within the traditional, within the sort of ecosystem payments and DeFi space, for instance. Things like MetaMask for instant transfers, projects like Exchange Union, who we're on testnet with now for instant ETH BTC swaps. But right now for this talk, I want to focus on kind of a breakout market that we've been seeing gaining traction, that we've been very excited about, and painting the vision of how we see Connext fitting into that space. So the decentralized web. This is something that people have been talking about for quite a while, especially within the Ethereum space. It's only starting to get traction now that folks have had the time to understand more about user problems, the technology has become more mature, and we've developed patterns around what seems to work for like shared incentive layers and things like that. Now, each and every one of these projects is very, very different, but one of the things that really tie them together are that rather than creating a market where you are purchasing content or goods or services from a set of providers. You are instead purchasing them from peers, other people running the same technology on their computers, and helping provide microservices for very, very, very tiny payments. Things like, for instance, on Audius, paying for tiny amounts of audio streaming content, in the graph, paying for tiny micropayments for queries, and so on. How does Connext fit into this vision? So before I get into this, I want to kind of do a little recap of what Connext is. I think a lot of people have heard the state channels bar tab analogy. I feel like it's like beating a dead horse at this point, and so I think I'm just going to be a little bit more general than that. What Connext is it's a system of unbreakable commitments. Basically, we create a pattern where any user can promise something to another user. This protocol actually works anywhere, but it needs to be tied to some sort of resolver. And that resolver is, the condition on that resolver is basically forces you to enact that promise wherever you are. So on Ethereum, this can be really simple. It could just be like a multi-sig contract. 2 out of 2 multi-sig, for instance, where if I want to pay Travis, I can, instead of sending him a transaction on the blockchain, I can just send him one of the 2 signatures that he needs to unlock funds from that multi-sig. Now, the important thing to note here is that this is actually a very generalizable primitive. I don't necessarily need to send a transaction. What I do with that multi-sig doesn't necessarily need to be an Ethereum transfer. It can be any contract call. It could be the state that I send to Travis, the things that I mutually agree with Travis about can be pretty much anything. And this is why we can extend this system into a network of unbreakable commitments. And this is where things kind of start to get interesting, because instead of just paying Travis, I can start paying Alice, Bob, Charlie, anybody else who Travis knows, and so on and so forth, until I never really have to move my funds off of a certain ledger. I can just sort of interact with people in this way and promise value to them, which can get settled and resolved much later in the life cycle of the payment. And this, because of the fact that we can put anything in these channels, this can happen in any currency, and in not just in any currency between any 2 people, but also over several currencies. So for instance, I can pay my friend Charlie in ETH, who can pay somebody else in DAI, who can pay somebody else in USDC. And that can happen all as one atomic transaction where the liquidity is all shared. And what's even more interesting is that it can also happen on any network. So what this means is that in the same way that I just described, where you're paying across different currencies, I can also pay a recipient that's on an entirely different network. So say, for instance, I want to transact with Travis and he's on Scale. I don't necessarily need to move my funds onto Scale. I, as a user, don't even need to know what Scale is. I just need to send a transfer through Connext. This is a totally different paradigm, and this is the part that kind of gets people hung up. Connext isn't a blockchain. State channel networks are not blockchains. They're actually a totally different kind of peer-to-peer primitive. The difference is like how TCP is different from a distributed hash table. They're used for entirely different things, and in fact, they're very, very complementary, even in cases where they don't seem like they would be. So a good example of this is a lot of the other layer 2 solutions that exist. It's kind of a pet peeve of mine, but the taxonomy of layer 2 solutions right now is that there's a base layer, which is Ethereum, and then there's a bunch of things that sit on top of it, and that can be optimistic rollup chains, ZK rollup chains, side chains, fruit rollups, whatever, and then state channels. And in fact, it's actually a little bit different. State channel networks sit on top of these sorts of ledgers. They don't really care what's underneath them. We actually work with some of these projects to enable instant transfers in and out of their chains. So these are complementary approaches rather than competitive ones. For the decentralized web, Connext is a configurable network agnostic shared incentive layer. What that means is that unlike anything, so there's a critical problem with everybody building their own incentive layer, which is that users then need to be onboarded into every single network independently. With Connext, it's one singular onboarding task in the process of getting them into a Connext channel, or even many Connext channels. And after that, the user just has one experience wherever they go. And that really, really changes how people interact with these things. We've seen that unlike anything that exists right now, and I guess we traditionally refer to them within the space of scalability solutions, but unlike anything that exists right now, this is the only thing that gives users that kind of an experience. And this is also the only thing that makes extremely cheap, extremely frequent transfers possible. And I'm talking about transfers on the order of like 0.00001 cents, which is what we're doing right now with some of the, or at least what we expect to be doing right now with some of the projects that we're working with. If you want to try it out, setting it up is easy. You can run a node on your own computer in just a few lines of code. It takes about 10 minutes to get set up and working. And once you do that, you kind of get an idea of how powerful it can be. It's not a one-size-fits-all solution for everything. It's not, like I said, it's not a blockchain. You can't really build a blockchain app on top of it, but it's not designed to be. It's designed to be a separate layer for projects that want to do things like peer-to-peer transfers, things like peer-to-peer swaps. And that's basically it. I try to keep it short. I know I know we're a little bit over. If you want to get in touch with us, hit us up on Twitter or in our Discord. We're super, super responsive. And let us know what you think of Connext if you do try it out. That's about it.
Arjun, thanks so much. That was great. Well, hey, thanks everyone. I know we went a little bit over here, but just really grateful for everyone just spending almost 2 hours with us, listening to all of these talks. And I would encourage you all to please follow these folks on Twitter. And just anyways, thanks again, everyone.
Thanks, Travis.
Thanks, guys. Take care.